the long end of the bond market is certainly getting our attention then, Mark. When it comes to Japan, also feeding into treasuries, though. 30-year treasury yields we see down by 7-8 basis points right now. US stock futures, to Kriti's point, pointing higher. They were higher on trade narratives, but maybe also higher then on expectations of slightly lower yields.
Yes, I think there's two different aspects here. First of all, I think the price action in the bond market, despite the fact it's a very sharp rally, is very worrying for bond investors. It shows kind of how nervous this bond market is and how low the liquidity is. You know, we always say about stock markets, the bear markets see the most powerful short-term rallies. And now we're seeing that in a bond market. And I think it confirms the fact that we are in a structural bear market for long-end bonds. I do not know how long this kind of relief rally in bonds will last. It may last for days or even weeks, but it is quite worrying, and I think that we're going to have much higher yields again later on this year because it shows this is a market that is very nervous around the bond market, even if they got over their skis. Now, we are seeing the fact that equities are rallying in the short term. Is that because we're getting lower yields, or is that just, again, a little bit of the low liquidity relief rally on the fact that Donald Trump, reverse decision on EU tariffs has delayed the kind of imposition of 50% and said that trade talks are accelerating, in the fast track program. So I think it's more just low liquidity. We're over-interpreting that signal. I expect that later on this week that we'll resume the Sell America trade. Whether it starts before the Nvidia earnings or not, I don't know.
Mark, latest thoughts on the dollar? Christine Lagarde thinks this is the euro's moment.
I think we shouldn't over-interpret kind of her point. I mean, it's true. The dollar will be in a long-term downtrend now. The world is overexposed to the dollar. Dollar share of global reserves as of the end of last year was 57.8%. That'll probably fall to below 50% in the next coming years. We've been in de-dollarization for the last few years. It's just very, very subtle and gradual. This is not about the end of the dollar. The dollar will remain the world's reserve currency. It's just about reducing exposure. So we're in a long-term dollar decline. However, the euro is not going to surpass the dollar as the world's reserve currency. The dollar is firmly entrenched. It's just about a smaller share of dominance. But yes, of course, the euro will benefit from that de-dollarization. It'll be one of the many currencies that will benefit from the fact that we are in a structural dollar depreciation trend. But that does not decide the short-term trading. And in fact, the very short-term price action, again, suggests that FX traders, the short-term traders, have got too bearish the dollar. We might get a bit more of a squeeze in the very short term, but people will sell rallies aggressively in the dollar.
Very quickly, where is euro-dollar going by the end of the year?
Going to go to 130 before 106. But, in the timeline, will that happen this year? Probably not quite this year. But I think that the next 10% move in euro-dollar is higher, even though the last 10% was also for a higher move.